We are 21 minutes into the trading session on Wednesday, November 5th, and BigBear.ai, ticker BBAI, is active. The stock is currently trading at $5.95 per share. That is a solid move up, gaining 3.84% or about 22 cents on the day. This move is happening on significant volume, with 3.77 million shares already changing hands, pushing the price near the morning high of $5.98. The stock gapped up slightly at the open from yesterday's close of $5.73 and has held those gains, showing immediate strength. Now that price action feels good. It feels like confirmation of the narrative that has driven this stock up over 310% in the last year. The expectation is that BBAI is the next great government AI contractor, a mini Palantir securing major defense and intelligence contracts that will guarantee future growth. But the reality that the market is ignoring this morning is what's scheduled for November 10th. When BigBear.ai reports its third-quarter earnings next week, the consensus analyst expectation isn't for growth. It's for a revenue decline of over 25% year-over-year, down to around $31 million. This follows a second quarter where revenue also slipped 18% due to disruptions in U.S. Army contracts. So we have a fascinating tension. The stock is trading with intense, forward-looking optimism, while its most recent performance and near-term forecasts point to significant contraction. This disconnect is the entire story of BBAI right now. Investors, especially those active on forums and social media, are understandably focused on the headlines. The company has announced positive news, most recently deploying its Veriscan biometric system for U.S. Customs and Border Protection at Chicago O'Hare International Airport. This is a significant commercial proof of concept, speeding up processing for travelers. This adds to the buzz from a new U.S. Air Force contract for its predictive intelligence platform. This is what the bull case is built on, the idea that these contracts, while perhaps small now, are the foothold for massive expansion within the Department of Defense and Homeland Security. Retail sentiment trackers, like those on StockTwits, show an extremely bullish reading, with polls suggesting over 75% of retail participants are optimistic. They see the 310% one-year gain and believe the momentum is just getting started. But the professional analyst community is sending a much more mixed signal, which reflects the underlying financial reality. Zacks, for instance, currently has a hold rating on the stock. They acknowledge the strategic alignment with defense priorities, but are clearly concerned about the execution lag and the shrinking top-line revenue. On the other hand, analysts at H.C. Wainwright remain positive, maintaining a buy rating. This split is healthy. It shows the debate between momentum and fundamentals. The average one-year price target from analysts sits at $5.95. That is not a typo. The consensus target is exactly where the stock is trading at this very moment, implying that in the eyes of the professionals, the stock is currently perfectly valued and has priced in all the good news from O'Hare and the Air Force. The bull case from here relies entirely on a massive earnings beat next week or guidance that blows away all current expectations. This brings us to the institutional and insider activity, which paints an even more complex picture. On one hand, institutional ownership has been rising. Filings from the most recent quarter show that 422 institutions are on the books, with major players like Vanguard and BlackRock holding the top spots. In fact, institutional shareholders added over 12 million shares to their positions recently, a clear sign that big finance wants exposure to this name. But then you look at the insiders. In the last 6 months, there have been 12 open market transactions from company insiders. All 12 of them were sales. There have been 0 insider buys. This is a classic divergence. Institutions are buying the story, but the people running the company are selling into the strength. Comment below with your average cost basis on BBAI if you're holding. It's important to know if you're in the green or if you're chasing this recent move. This divergence between insider selling and retail buying, combined with the high valuation and shrinking revenue, has made BigBear.ai a prime target for short sellers. This isn't a guess, the data confirms it. Recent estimates place the short interest as high as 27% of the free float. This is a very high number and signifies that a significant amount of capital is betting that the stock price will fall. The short sellers aren't just betting against AI, they are betting on a specific and sober thesis. Their thesis is that BBAI is burning cash. Its valuation is completely detached from its financial reality, a price-to-sales ratio far above industry norms, and that the company will be forced to dilute shareholders to fund its operations. This dilution risk isn't theoretical, it's written into the company's financials. BBAI is carrying a significant amount of convertible debt, notes that can be converted into common stock at a price around $3.55 per share. Furthermore, the company has a $150 million at-the-market or ATM equity facility. This ATM facility essentially gives the company a green light to create and sell new shares into the open market whenever it needs to raise cash, which can put constant downward pressure on the stock price. The short seller thesis is that the insiders are selling because they know the company needs cash, and the only way to get it is by diluting the very retail investors who are bidding up the stock. This is the reality that is fighting against the expectation of endless AI-driven contract growth. So, what's your take on the disconnect? Are the insiders selling because they know the fundamentals are weak, or are they just taking profits on a massive run? Let me know in the comments. For investors trying to navigate this, the first actionable step is to know where to look. You can track institutional ownership through 13F filings, which are public. You can get official short interest data directly from FINRA, which is released twice a month, though services like Fintel or Ortex provide more frequent estimates. When you see a high borrow fee rate, which is the interest rate shorts must pay to borrow the stock, it signals that demand to short the stock is high. Right now, with 27% short interest, that rate is almost certainly elevated. The responsible way to interpret this is not to look for a short squeeze. Chasing squeezes is gambling. The responsible way is to understand that there is a large, well-capitalized group of investors who believe the stock is overvalued due to its fundamentals. The November 10th earnings report will be a major test of their thesis. For those who are new to the story, the company itself, BigBear.ai, operates in the decision intelligence space. That's a term for using artificial intelligence and machine learning to analyze massive, complex data sets to make predictions and help organizations make better decisions. Their business is divided between government and commercial clients. The government side, which has historically been its bread and butter, serves the defense and intelligence communities, helping with things like predictive logistics, battlefield awareness, and intelligence analysis. This is where their Conductor OS and Arcus platforms are used. The commercial side is newer, but gaining traction, as seen with the O'Hare Biometrics contract. They are trying to take their government-grade technology and apply it like supply chain management, logistics, and now facility security. The core idea is strong, but the business model is struggling to transition from lumpy, project-based government contracts to a stable, growing revenue stream. Looking forward, the path for BBAI is entirely dependent on one thing: proving the short thesis wrong. The future outlook is a binary event, hinged on the November 10th earnings call. The bull scenario is that the company decisively beats the low revenue estimates. If they announce that the Q2 Army contract disruption is over and that new contracts from the Air Force and O'Hare are already contributing to the top line, the stock could move violently upward. If they can show they are controlling cash burn and do not plan to use the ATM facility heavily, the 27% short interest will be in serious trouble and a genuine, fundamentals-driven rally could begin. This would prove the expectation: AI growth was correct, and the reality, shrinking revenue, was just a temporary lag. The bear scenario is that the company meets, or even worse, misses those already low revenue estimates. If management confirms that revenue will be down 25% year over year and offers weak guidance for the fourth quarter, it will validate every single point of the short thesis. It will confirm that the valuation is unsupportable. In this scenario, the insider selling will look prescient and the institutional buyers will look like they bought the top of a hype cycle. The stock price would likely break below its recent support levels as the market is forced to reprice the company based on a reality of shrinking fundamentals, not the expectation of future growth.